Hello, everybody. This is Lois and David, and we wanted to give you a Friday afternoon funds report that we're going to just kind of take a look and let David mainly tell you what's going on, and then I'll chip in every now and then.
Great. So it's Friday afternoon, and Worthwhile Wealth Council, most of you know, looks at the weekly performance of our funds and the index benchmarks that we look at for all 22 plus asset classes. And it's always interesting to us to look at the patterns because that's why we're invested in each of these. They tend to behave differently under circumstances. When we have a really crisis like we've seen in the market in the last few weeks, it always shows us something new. No bear market is the same as the one before, and we think it's worth sharing some of these observations. So 3 weeks ago, and keep in mind that when we're looking at this report, we're looking from last Friday's weekly performance. So it's Friday again, and this goes back not just this week, but the week before. I'm looking at a report from the week before that. So 3 weeks ago, if you look at the Dow Jones Industrial Average and the S&P 500 and what we use for the large growth part of the stocks, we see that we were 25.75% down on the year for the Dow Jones Industrial Average 3 Fridays ago. And the S&P was 22.5% off, and the large cap growth, the large companies that are growth companies, were down 18%. If you look now at this week, after 2 weeks of significant rise, at the end of last week, the Dow was just 14.5% off, the S&P was 10.5% off, and large growth, just the growth companies, were only off 3.5%. So like a big bomb going off, we're down in a hole and we're climbing up, and with large growth, part of what is in our allocations, we can see the edge. We can at least climb up and see the edge of that. So that's looking back over the last few weeks in just those large company indicators, the Dow Jones, the S&P, and just large growth. If you go down in our funds report, the next thing that we see is technology, and it was up a full 5.5%, a little more than large growth. Had been up last week just 4.75%. And technology, the technology benchmark is just 1.6% away from even year to date. Healthcare is even closer. It's less than a half a point short on last week's report from year to date. So healthcare was up a full 6%. If you drop to the next category, we look at large value. That would be the other side of large companies. You have growth, and value is only up a half a percent, and it is still 18% short, 18% off on the year to date. If you drop down to mid-sized companies on the growth side, that was up 1.5%, but still remains 16% short. If you go to mid-cap value, it was actually down another 2.5% last week and remains 31 and 33% off. So that's still not recovering, not anywhere near close to the edge. Small growth was up a little bit, about a half a point, but still remains 21.5% negative for the year. And small value was down a bunch more, 3.6%, and is off 37.5%. So when we look at the U.S. stock market, we look at these benchmarks, we look at the Dow Jones and the S&P that you see on the news every night, and what you don't see on the news is just large growth companies, just large value companies, just mid-sized growth companies, and just mid-sized value companies, and the same for small companies, both the growth and the value. And Lois, you have a way of kind of thinking about those, don't you?
Yeah, I love watching large growth and value, mid and small. And this is just my simple way of looking at it. I act like there's three families, and one family's last name is large, and the other family's mid, and the other family's small. And within all three families have two children. One of them is named growth, and the other one is named value. The middle family has the same kids, growth and value. And so I love it, love it, love it. The growth kids usually are outgrowing and outperforming the poor little value kids. And every now and then the value just beats up and whomps up on the growth kids.
And you
However,
like that,
I
right?
like that. I
Yeah, but
like
that's
that.
because
I go for the underdogs.
You're the underdog.
The
That's
underdogger.
right. Yeah.
But and when a bomb lands, though, especially now, looks like the value kids are kind of, they're way down in the hole. They're hiding. They're much further down in the hole than the growth. But they will catch up, won't they?
They will catch up eventually. They'll overtake growth for some period. And just historically, value is favored by some analysts because the value side of things tends to do better on a risk adjusted basis. So while you've got the sort of the tortoise and the hare, this is one of those spurts for growth coming back from that bombshell. So the other part that we like to look at is going across our report, which gives us the trailing period. That is, how have these areas done for the last year, the last 2 years average, or 3, 5, 10, and as far back as 15 years. Now, if we look at large growth as an example, which is just 3.5% behind for this year and was about 25% behind, if you look at the 1 year trailing, it's still over 11%. That's pretty darn good. Well, why was it? Well, because the growth between last year and the early part of this year was so high that even the downturn has kept it in above 11%. If you go to a 2 year average, it's even better, 11.3. The 5 year average is still 15%. The 10 year, that was the 3 year, I'm sorry, the 5 year is 11.9. The 10 is 13 and 3/4, and even the 15-year trailing period is above 10 at 10.8. So it's almost as if nothing happened. And that's a perspective we don't get when we're in the middle of recovering from a bombshell. If you take that same perspective and go down into the other family members, the mid-size or the large value family, the large value family is still negative 9% for a year, still negative for the 2 years, 1.8%. Doesn't get positive till you get to the 3 years, which is 2.6. The 5 is just 5.25. Now when you get to the 10-year average, it's decent, 9.08. But because this bull market has been, that we had before the downturn, has been so much better to growth companies, which is what typically happens, the 15-year is still looking at 6.5% for large value. When you get down to the smaller companies, when you go to mid growth, you're negative 9%, almost 10. You have to get to the 2 year where it is, or the 3 year where it is 5.3. The 5 year is 4.5. You have to get to 10 years to get above the 10% range, and it's still 10% at the 15-year. When you look at the value side, so mid-sized companies that are value, there's nothing decent there till you get to 10 years, and it is just 7.3. And then the small companies, even worse. You get on growth, you get 9% at 10 years, but just 2 at 5 years, and just 1.5 at 3 years. Still very negative at the 1 and 2 years.
So this bull that I've loved so much has favored those growth kids.
Oh, the growth kids have just,
they've had a party, a wild party.
But here's the thing: we were not, of course, expecting this sudden downturn. This just snuck up on everybody. Nobody knew it, and it's because it's a medical concern. We had this pandemic that just blindsided us. Had we gone into a more predictable, there are times when people say, "Oh, there's a bear market coming. There's a bear market coming," and after a while, you begin to think, prices really are too high, and we're gonna, there's a recession out there someplace. It's got to happen. When that more typical kind of a bear market comes along, which again we don't see it even with this having happened now, value will probably suffer less and do better through that bear market than like we had
Mm-hmm.
with this and in 2008. If you go back to the tech bubble burst, small value companies were still doing positive until the third year after the tech bubble burst. So it's just fascinating to see these
Tech
patterns.
bubble. Sounds like we're dinosaurs. We've been around a while.
Yeah, that's true. We
That's
have.
one reason our clients like us, though. We have a lot
Yeah,
of experience with these bear
when we
markets.
started in this '94, that was considered a bear market. It was off maybe 2%.
And I started earlier than that after
Oh,
Black
I
Monday.
know you did.
I'm ancient.
Yeah, you
Okay, so this we hope this hasn't been boring. We just want to let you know that basically the funds are down in a hole, but they're coming up every week. And you're not going to get that on the news. But everything, the market is going up. We just got to climb out of a hole.
and you're spread out over everything. This could have been exactly the opposite. It could have been that value didn't take as much of a hit,
Exactly.
and small companies didn't take as much of a hit. It just happens to be that these other places in your portfolio have suffered less. Anytime a bomb goes off, it's going to do
You run
more
for shelter.
damage. It's going to do more damage in some places than it does in others.
Our funds
So,
are in the bomb shelters.
yeah, there's, they've been tattered.
What is my favorite game? Is it Whack-A-Mole?
Yeah,
Whack-A-Mole?
whack-a-mole.
Yeah, I
Yeah.
love Whack-A-Mole. So just if you can imagine that great big board with all those holes and the funds have been coming up and all of a sudden this bomb just took a hammer and has been beating them all down. So it's,
Nice picture.
thank you.
Hope this was helpful.
We do.
Happy Friday.
Happy Friday, guys.
Have a
Have a
great
great
weekend.
weekend.
Stay safe,
Stay
stay healthy,
healthy,
and
stay
stay tuned.
tuned.